Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, you're listening to the Daily FX Navigator. My name is DJ, your host for the series. So markets have turned sharply risk-off in less liquid post-holiday New York trading, driven by the potential threat of the Omicron coronavirus variant to the narrative of global recovery and normalizing monetary policies. Equities and bond yields slipped, oil fell more than 10%, and the dollar eased before partially recovering. On currencies, safe havens like the Japanese yen and Swiss franc gained, reversing recent price action, while high beta FX like the Australian dollar, New Zealand dollar, and Canadian dollar edged lower. So far, we've seen some recovery in risk sentiment as investors await further information about the variant. Our focus is on dollar yen today and why we expect the short yen squeeze to persist for a while. Dollar yen has traded between 113 and 114 after Friday's sharp decline from around 115.35. Japan has closed its borders pending analysis of the Omicron variant as global policy divergence extends beyond the monetary and fiscal arenas. So adding to the case of bad timing for a new variant of concern is waning immunity and low booster take-up across major countries. Short yen positioning has been stretched for a while now, given that this is where we've seen most of the recent short bets in the G10 FX space. Now those have been concentrated here. High beta currencies have also been hit by the recent wobble in risk sentiment, but currencies like the Australian dollar and British pound could be cushioned given the already elevated bearish sentiment for them. The Canadian dollar, on the other hand, may be susceptible to a near-term reversal if we do see a dovish Bank of Canada repricing or further oil price weakness. If you're looking to play the view on risk sentiment staying relatively fragile, going short CAD yen may make sense. Going back to dollar yen, we expect the pair to trade in a range near term with a bias towards further downside risk to 112.70 and 111.65. On that note, a move above 114.60 could signal a return to previous 115.50 highs. Remember, as we head into the holiday season, market liquidity will likely be lower then, and that means more volatility ahead. Ultimately, the medium-term view for dollar yen is still arguably mixed as the tug of war between higher US rates and the yen's cheap valuations continue to play out. And that is all the time we have for today. You know we like keeping things short and sweet over here. If you're a valued client of Standard Chartered, grab hold of your relationship manager to find out more about our publications. If you've enjoyed what you've heard, remember to like, share, and subscribe. And that sums up today's podcast. See you next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.